Hello, everyone. Good evening. I'm going to tell you a story, and it's one that you just lived through, and it's still going on. And man, everything that just happened was all planned ahead. We're going to take a look at the story 4 years later in hindsight. Let's take a look. Chapter 1 The Plan. Well, the BlackRock plan, what I should say, because in August of 2019, right before the pandemic hit, we had a meeting that consisted of about 200 or so CEOs from around the globe. And this document was released entitled Dealing with the Next Downturn. And I'm going to give you a summary of this in this part one, because once you learn the scope of what actually happened, you can read the documents and follow along as to what their planning entailed throughout this time. And then you look at what happens on social media and the general population, and it's very concerning. So the title of this is Dealing with the Next Downturn: From Unconventional Monetary Policy to Unprecedented Policy Coordination. Now, we're going to summarize this in different sections that this document talks about. And the first one is unprecedented policy needs. Now, the next economic downturn will require unprecedented policies. With global interest rates nearing zero or even going negative, monetary policy is almost exhausted. Relying solely on fiscal policy might not be timely or effective due to high debt levels and implementation delays. There's a risk of blurring the lines between fiscal and monetary policies, which could threaten the credibility of policy institutions. The paper suggests a framework for coordination through a monetary financed fiscal facility. And if you've been following me for any amount of time, you already know what that facility is. We're going to get to that and touch on that later on. But let's continue on. The second section is entitled Monetary Policy Space is Limited. Now, this is the interest rate chart from 2017 to 2023, and you look at this document, you hear them talking about interest rates being near zero. Well, at the time of this document being written, they were right around 2 to 2.5. And after this was published, after all of this went down, so did rates. They plunged to, well, near zero. Now, the current policy space for global central banks is limited. Conventional and unconventional monetary policy primarily operates through the stimulative impact of lower interest rates. However, a significant portion of the developed market government bond and investment grade universe now has negative yields. Fed enters right around this time in September of 2019. September 17th, to be exact, is when the Fed enters into the market, and the rates drop to zero. That is their first act in this game. They started to play, and the game changed officially on September 17th, 2019. Again, when the Fed entered and began their control, basically, over pretty much everything market related and lending related. Now, the role of fiscal policy. While fiscal policy can stimulate activity without relying on lower interest rates, it might not be nimble enough on its own. With global debt at record levels, significant fiscal stimulus could raise interest rates or create expectations of future fiscal consolidation. So, what are they saying? With global debt at record levels, significant fiscal stimulus could raise interest rates or create expectations of future fiscal consolidation. So, what they're saying is that significant fiscal stimulus that could raise interest rates, which is what they need. So they lowered rates so that they could raise rates, but they also lowered rates for another very crucial reason, and this comes down to supply. And we'll get into that in another video, but yes, all written down. Debt, global debt at record levels, significant fiscal stimulus could raise interest rates or create expectations of future fiscal consolidation. So they touch a lot on, the psychology of inflation. If inflation's expected to be high, wages will be expected to grow, obviously, because inflation and wages, when they grow, they go in tandem. If rates remain low and inflation remains low, there's no monetary incentive to increase wages. So it's all a catch 2022, or 22, I should say. let's move on here. Now, again, the role of fiscal policy, while fiscal policy can stimulate activity without relying on lower interest rates, it's not nimble enough on its own. And we look at the Fed lending versus the Fed borrowing. They tried lending in 2007, 28. You can see the blue line there, the little hump right here. And then Fed borrowing, starts to skyrocket all the way up through 2018. So this is the issue, right? So this is the precursor to what we are about to look at. Now, another big section in this document is titled Going Direct, which basically says an unprecedented response is needed when monetary policy is exhausted. Now, remember, this is coming all out of BlackRock. Look at BlackRock's stance in the market right now. They have a shit ton of assets under management, trillions of dollars, which is, it's like Ken Griffin. Everyone talks about Ken Griffin. BlackRock makes Ken Griffin look like a piss ant with how much more capital they manage. But anyways, an unprecedented response is needed when monetary policy is exhausted, and fiscal policy alone isn't sufficient. This involves going direct, where the central bank finds ways to get central bank money directly to spenders. So how did they do that? With stimulus checks from the pandemic. Hola, buddy. Now, this bypasses the interest rate channel and enforces policy coordination. So, basically what they're saying up to this point, rates are too low, inflation's too low. They need inflation to go up. They need rates to go up. Fed comes in, lowers rates near zero. The crisis pandemic happens. What a perfect time to give stimulus when the rates are at zero. Exactly what they need, as discussed and disclosed in this document. And then lo and behold, they get their answer from the heavens, the situation needed to enact this exact monetary policy / fiscal policy hybrid. And it says right here that it bypasses the interest rate channel and enforces policy coordination. Now, the post-crisis progress. Remember, this is before any of this shit happened. Before any of it happened. The global economy has made significant progress since 2007-2009 global financial crisis. The use of unconventional monetary policy and tighter financial regulation has fostered the longest U.S.-led expansion post-World War II. However, bringing inflation back to target sustainably remains a challenge. Now, again, at this time, inflation was not high at all. So if the target is 2% from the Fed, by the end of next year, Q1 2025, then why did we were there before the Fed even came in? So they came in at their target and had to engineer inflation, had to engineer the rate hikes that we're seeing because they have to pay off the fuckloads of debt globally. And it's all done through repo suave. You already knew that, though. Now, again, they're saying in this document before COVID, before the COVID crisis happens, that the use of unconventional monetary policy and tighter financial regulation has fostered the longest U.S.-led expansion post-World War II. Like, they're almost coming off like that's a bad thing. And then they go on to say, bringing inflation back to target sustainably remains a challenge. So what do they do about it? Well, they have an unusual starting point. A decade into unprecedented monetary stimulus, inflation and inflation expectations remain low in most major economies. Now, you would think that's good, right? But no, again, it's psychological. This is unusual to them, especially in the late cycle stage when concerns typically focus on overheating. So again, there's parts of this and areas of this that was not playing out how they wanted to long term back in 2012 when the OECD and all the other major countries and all the Atlantic Council and all those groups formulated these global plans that they were going to carry out over the next 2 decades. So what came of this plan? In essence, basically, the document suggested and suggests and did suggest the central banks, like the Fed, might need to explore unconventional methods to achieve their inflation targets, especially when traditional tools are exhausted. So, what did we see happen over the last few years? We saw inflation at relatively low levels. compared to where they were, a year ago. We saw it skyrocket. We saw it start to drop off then again this year. But there's something that's very important that ties to this whole document. At the beginning, they talked about financial, or a facility that needs to basically finance all of this. That's going to be a collaboration and coordination amongst global leaders around the world. What kind of place would this be? Repo Suave, man. Look at this shit. Again, this is the crux of it all. It's the crux of it all. If you're not checking the repo every day at 12:15 on the Fed's website when it comes out and it posts every day, I mean, there's a lot to gain from that knowledge, because what they're essentially doing is this is the engineered inflation right here. Because if you put a line next to this, if you look at an inflation chart and you put it side by side with this one, it's the same thing. If you look at the short interest, it's the same thing. Guess what happened this year while the market was trending up? The short interest went down. It's not rocket science. It's just they've done a very, very good job at covering up something very simple that's been right in front of everybody the whole time. But they know that no one's going to read this shit. No one's going to care. No one's going to put two and two together because we're all busy liking each other's videos that, may or may not be accurate. But whenever you read from documents, it's kind of hard to be wrong unless you're just retarded, which I am. So if you haven't already, don't forget to unlike and unsubscribe, because you're definitely not going to want to see the next part of this whenever they change Regulation D, implement SLR, and go on a effing buying spree for a year straight. And then that's when you, me, and all the friends entered in early 2021 when they pointed the finger at retail and they lured us all in by taking the buy button away. God damn, it's good to be alive. Oh yeah, by the way, the reason why this chunk right here is non-existent for the repo is because that's when rates were low, stimuluses were coming out, and SLR was implemented in this exact time span. SLR expired the day after. Guess what happened? Repo Suave came in, and god damn it, I didn't get the Repo Suave GIF for this presentation, which is a disservice to anyone in the group because he needs to be here. So that's my bad. So that's more reason why you should unlike and unsubscribe. But anyway, the macroeconomics tied to all the the shit that we've seen, despite what you may believe with your friends on Reddit, or despite what feels good, it's a lot different when you actually look into the words on the papers that these people all wrote about before all this shit even happened. So crazy shit. I'm gonna go get baked now.